All right, let's get into it. Today, we're breaking down one of those trading days that just gives you absolute whiplash. You know the ones. It was a classic Which Way Wednesday, where it felt like every single piece of data was contradicting the one before it. You had these scary, recession is coming headlines clashing with a surprisingly strong economic core. So let's unpack this wild tug of war between fear and the actual facts.
And honestly, this quote from Phil Davis at PhilStockWorld.com just nails the feeling perfectly. It's like, the second you think you've got the market figured out, the rulebook gets completely rewritten. That exact feeling of constant, drastic change was the perfect backdrop for the chaos we all saw play out on Wednesday, February 18th.
The whole day was really a battle between these two completely different faces of the market. I mean, on one side you had headlines practically screaming recession, a huge miss on durable goods, tech and software stocks getting hammered, and this constant chatter about a hawkish Fed. But then, if you actually looked under the hood, the core data was telling a totally different story, a story of a healthy mid-cycle recovery. This split, this is what we really need to dig into.
Okay, let's start right at the opening bell. The 8:30 a.m. data release was, well, it was a masterclass in how trading algorithms can get completely suckered by a misleading headline number, and more importantly, how a human trader can spot that confusion and find a real opportunity.
And this was it. This was the big, scary number that flashed across everyone's screens. Negative 1.4%. A huge miss. And it's exactly the kind of thing that trading algos are programmed to see and just instantly slam the sell button. At first glance, it looks awful, right? But this is where you got to put on your detective hat, Think like Sherlock from the AGI roundtable, who's always digging for the evidence that's hiding in plain sight. Is this one number, this negative 1.4%, really the whole story? Or is there something much more important buried underneath?
And boom, here's the deception right here, the trap. The moment you strip out the gigantic, lumpy, and super volatile aircraft orders, from companies like Boeing, the entire picture just flips on its head. The core orders, the stuff that really shows what businesses are buying and investing in, were actually up a very strong 0.9%. So the headline looked like a recession, but the core looked like a healthy recovery.
And it wasn't just a one-off thing in the core orders. Zephyr, the data guru from the AGI roundtable, would be all over this. The signal from the real economy was loud and clear. Housing starts and building permits both totally crushed expectations. Industrial production came in hot at plus 0.7%. I mean, come on, this is not the data of an economy that's about to fall off a cliff. It's the data of an economy with some real, solid demand under the surface. So, with that morning head fake in the rearview mirror, the market's entire focus just snapped to the main event of the day. The 2 p.m. release of the Fed's meeting minutes. This was it. This was the moment that was going to set the tone for the rest of the day and maybe even the rest of the month.
So here's the roadmap for the rest of our crazy day. We just navigated that 8:30 a.m. algo trap. The next big stop is the 2 p.m. FOMC minutes release, which is what totally sets the stage for the market's really surprising rebound right into the 4 p.m. close.
Now, this is where it gets really interesting. Jubal, the AGI Roundtable's expert on rules and risk, actually called this out in the morning. The market was feeling pretty optimistic, kind of dovish, but Jubal made a key point. These minutes were from a meeting that happened before the latest soft inflation data came out. So the big risk was a hawkish surprise, a look back at a Fed that was still way more worried about inflation.
And right on cue, the minutes drop, and the market gets its second major head fake of the day. For a quick minute there, it really looked like Jubal's prediction of a hawkish reality check was about to send stocks into a nosedive. 2 o'clock hits, the document goes live, and you can just imagine all these supercomputers parsing thousands of words in microseconds, just hunting for those key phrases: inflation, risks, rates.
And there it was, the money quote, the one that sent a chill through the market. Just the mention of raising rates was the absolute opposite of what the bulls wanted to hear. It confirmed exactly what Jubal warned about. Inside the Fed, the conversation was way more worried about inflation than the market was pricing in. And that initial reaction was, well, it was swift.
But then, the strangest thing happened. That sell-off, that knee-jerk reaction to the scary headline, it just fizzled out. And the market didn't just find a bottom, it started to rally. So the million-dollar question is, why? Why on earth did stocks just shrug off what looked like really bad news from the Fed?
And you can see that whole roller coaster play out right here on the chart. The S&P is trading up near its highs right before 2 p.m. The minutes drop, and you get that quick, sharp dip. But then, look what happens next. A powerful rally right into the close that erases the entire dip and then some.
This dip and rip is telling us something. It's telling us the market took the punch and found a reason to buy anyway.
So by the time the closing bell rang, the major indexes were all firmly in the green. The tech-heavy Nasdaq actually led the way, while the defensive, safe sectors like utilities and staples were lagging. That's a classic risk-on signal, right? The market wasn't scared. It heard the Fed's tough talk, and the underlying desire to buy was simply stronger.
So what was that underlying bid? What was this mysterious force that the headlines completely missed? This brings us to the real story of the day, a concept that explains this seemingly crazy strength, something we can call stealth easing.
Okay, this is the key takeaway from the whole day's analysis. The Fed is basically running a two-tool regime. Tool number one is their public language, talking tough on rates to keep everyone's inflation fears down. But tool number two, the one happening quietly behind the scenes, is the continued injection of liquidity into the system. They're talking like hawks, but they're acting like doves, and that creates a safety net for the market.
And this analogy from Phil's end-of-day report just crystallizes the entire idea perfectly. The Fed is basically saying, hey, we're putting the rate hike scissors down for a minute because our inflation tape measure might be broken. But don't you worry, we're going to keep feeding the system cash so the whole thing doesn't snap. See? The market heard the words, but it felt the liquidity.
And that really leaves us with the ultimate question for anyone trying to navigate this environment. The Fed's words are hawkish, designed to sound tough, but its actions, the actual flow of money, are providing a powerful tailwind. This whole conflict was the entire story of Which Way Wednesday, and figuring out which one of those signals to follow, well, that's the key to this whole two-faced market.